Hello everyone. Welcome to Sam's Summaries. This episode is a deep dive discussion into Sam Fury's summary of Chapter 12 from the book How to Swing Trade by Brian Pazim. It has been created with the help of AI. The chapter is titled Swing Trading Strategies. You can read the original post at samfury.com.
All right, let's swing into action today, huh? We're going deep on swing trading strategies.
Sounds good.
Straight from the source. Brian Pazim's book, How to Swing Trade.
Okay.
We're looking specifically at Chapter 12, where he kind of lays out 3 core approaches.
All right.
Almost like a cheat sheet for finding, those sweet spot trades.
Yeah.
And those 3 approaches that he breaks it down into are regular scanning,
Okay.
short-term gap trades,
Right.
and those exciting hot sector manias.
Yes.
So by the end of this deep dive, you'll have a really solid grasp of each one, ready to apply what works best for you.
What I find interesting is that these strategies, they're not mutually exclusive. Like you can use them in combination, almost like different lenses for viewing the market. Right?
Okay.
But even before you think about picking stocks, Pazim, he stresses the importance of knowing your terrain. And that's really where regular scanning comes in.
Makes sense. It's like having a routine checkup,
Yeah.
but for your portfolio.
Yeah, exactly.
He talks about using broker services or finviz.com,
Right.
which seems pretty user-friendly.
Yeah.
So walk us through, what this regular scanning actually entails.
Well, it's a 4-step process, each step kind of building on the last.
Yeah.
And the first step, reviewing overall market conditions, it might seem obvious, but Pazim emphasizes that many traders skip this entirely.
Right.
They just jump right into stock picking without kind of considering the bigger picture.
Yeah.
Right? So instead of fighting the current, you want to ride the wave of the market's momentum.
Okay, so how do we figure out which way that wave is going?
It's like checking the weather before you go sailing.
Okay.
You need to know if it's a calm day or if there's a storm brewing.
Right.
So with FinViz, you can instantly see the overall market sentiment.
Okay.
Are stock prices generally rising or falling? How many stocks are hitting new highs versus new lows? And how are prices behaving compared to their 50-day and 200-day moving averages? So these are all clues that tell you whether the market is leaning bullish, meaning prices are generally expected to rise, or bearish, suggesting a downward trend.
So we're looking for visual cues, those telltale signs that kind of give us a sense of the market's mood. And once we've got a read on the overall market, we zoom in a bit. Right?
Exactly. Step 2 is all about reviewing market sectors.
Okay.
Think of sectors as different neighborhoods within a city, right?
Okay.
Some neighborhoods might be booming while others are struggling. So Pazim wants you to look for alignment between the sector trend and the overall market trend.
So if the overall market is feeling bullish, we ideally want to find sectors that are also showing strength.
Precisely. And FinViz makes this easy to spot, with color coding. Green generally indicates a bullish sector, while red signals a bearish trend.
Okay.
You can even analyze this across different time frames, like, day, week, or month, to gauge the sector's momentum.
So it's like checking the pulse of each sector, seeing which ones are thriving and which ones are lagging behind. Okay. So we've assessed the overall market, zeroed in on some promising sectors.
Right.
What's next?
Step 3 is where the real action begins. Screening for opportunities.
Okay.
And this is where you get to be picky.
All right.
You set specific criteria to filter down to a manageable list of potential winners.
It's like having a personal stock picking assistant, right?
Exactly. And FinViz offers a really powerful set of filters.
Right.
And these filters are categorized as descriptive, fundamental, and technical.
Okay.
So let's start with descriptive, where it's all about establishing some ground rules.
Okay.
So Pazim suggests a minimum average volume of 200,000 shares per day.
Okay.
This ensures that you're dealing with stocks that are actively traded, making it easier to get in and out of positions.
Right.
He also recommends setting a minimum price, like $2, to avoid those volatile penny stocks that can really burn inexperienced traders.
So we're filtering out the noise, those stocks that might not be worth our time or carry more risk than we're comfortable with.
Yeah.
Now, what about the fundamental tab? This is where we start digging into the company's financial health, right?
Yes. But Pazim advises starting simple, especially if you're new to fundamental analysis. You don't need to become a Wall Street analyst overnight.
Right.
The key is to look for companies that are fundamentally sound.
Right.
Those with a solid track record and a promising future.
Okay, so what are some basic indicators of a financially healthy company?
Well, Pazim highlights three key metrics for long opportunities, those trades where you're betting on the stock price going up.
Okay.
First, look for sales and profit growth.
Yeah, okay.
Is the company expanding its revenue and earnings?
Right.
Second, check the debt-to-equity ratio.
Okay.
A ratio below 1 suggests the company isn't overburdened with debt.
Right.
And finally, consider the return on equity, or ROE.
All right.
A higher ROE, ideally above 20%, indicates that the company is effectively using its shareholder money to generate profits.
It's like checking the vital signs of a company, making sure it's in good shape before we invest.
Exactly. And these are just a few starting points. As you become more familiar with fundamental analysis, you can delve deeper into other metrics like cash flow, earnings per share, and price-to-earnings ratio.
So we're not just chasing trends, we're looking for companies with solid foundations, those built to last.
Yes.
Now, what about the technical tab?
Right.
This is where we get into the exciting world of charts and indicators, right?
Yes. This is where we analyze the stock's price action to identify potential buy signals.
Okay.
Now, for long opportunities, PZIM focuses on signs of a strong uptrend.
Right.
Think of it like a rocket taking off.
Okay.
You want to see that stock price steadily climbing higher,
Okay.
consistently trading above its key moving averages, like the 20-day, 50-day, and 200-day.
So we're looking for those stocks that are defying gravity, those with upward momentum.
Yes.
But what if a stock isn't already in an uptrend? Are there clues that might signal a potential turnaround?
Absolutely. Pazim calls these bullish reversal patterns, and they can be incredibly powerful signals. One example is the double bottom pattern. It looks like a W on the chart, and it indicates that the stock has bounced off a support level twice, suggesting buyers are stepping in and potentially shifting the momentum from down to up.
It's like the stock is testing the waters before diving in for a swim to the upside.
Yeah.
What are some other signs of a potential bullish reversal?
Pazim also highlights candlestick patterns like engulfing candles and dragonfly dojis. Now, these might sound intimidating, but they're essentially visual representations of buying and selling pressure at specific points in time.
Okay.
The key is to look for patterns that suggest buying pressure is increasing, potentially signaling a shift in momentum.
Oh, so we're analyzing those visual cues, those hints that the market is giving us about potential future price movements. And we can further refine our search using technical indicators, right?
Absolutely. Pazim suggests considering indicators like the Relative Strength Index, or RSI.
Right.
Think of the RSI like a thermometer for a stock's price momentum. For long trades, an RSI below 30 could indicate the stock is oversold, meaning it might be due for a bounce.
So we're looking for those stocks that might be temporarily out of favor, those that have the potential to rebound. What other technical indicators can help us narrow down our list?
Well, Pazim also mentions the short float, which is the percentage of a stock's shares that are currently being shorted or bet against.
Right.
A high short float can sometimes create a situation called a short squeeze, where short sellers are forced to buy back the stock, driving the price up.
It's like a game of tug of war, and suddenly the buyers gain the upper hand, pulling the price in their direction.
Exactly. And finally, you can consider earnings per share, or EPS, growth. This metric tells you how much profit a company is making for each outstanding share of its stock.
Right.
So, strong EPS growth is a good sign that the company is on solid financial footing.
It's like checking the engine of a car before you buy it,
Yeah,
making sure it's running smoothly and has the power to take you where you want to go.
exactly.
Okay, so we've narrowed down our search using descriptive, fundamental, and technical filters. We've gone from a vast sea of stocks to a much smaller pool of potential contenders. What's step 4 all about?
Step 4 is where you put on your detective hat and review the shortlist. This is where you go beyond those initial filters and dig deeper into each potential trade.
So it's like we've identified a few promising leads, and now it's time to investigate further. What are we looking for during this final review?
First, examine the charts.
Okay.
Are any of those bullish reversal patterns we discussed playing out? FinViz automatically plots support and resistance lines on the charts, which can help you visualize potential entry and exit points.
Support and resistance. Those are like the battle lines between buyers and sellers.
Yeah.
Okay, what else are we looking for?
Take a quick look at the sector. Is it currently in favor? Are there any major news announcements expected for the company? And you can always check those key technical indicators we talked about, like the RSI, which helps you assess momentum and potential trend changes.
So it's a final check, making sure everything aligns before we make our move. This regular scanning process seems like a great way to consistently uncover promising trades. But what if you're looking for something a bit more, well, fast-paced,
Right.
something with the potential for quick gains. That's where our next strategy comes in. Short-term gap trades.
Right. Gap trading is a completely different approach. One that capitalizes on those sudden price jumps or gaps that can occur between a stock's closing price one day and its opening price the next.
Okay.
These gaps are often triggered by, news events that happen after the market closes, creating a surge of buying or selling pressure when the market reopens.
So it's about catching those waves of volatility, riding those price swings for quick profits.
Exactly. But there is an inherent risk involved. Pezim warns that a stock could gap below your intended stop-loss price, potentially leading to larger losses than you anticipated.
That makes sense. If a stock plummets overnight, you might not be able to get out at your desired price.
Yeah.
So how do we manage that risk?
Well, stop-limit orders can help mitigate this risk. These orders combine a stop-loss order with a limit order. You're essentially setting a floor on the price at which your order will be filled. And of course, closing all your positions before the weekend can help you avoid those overnight surprises.
So it's about being proactive, taking steps to protect ourselves from those unexpected price swings. Now, Pezim talks about this 3-day rule in relation to gap trading. What's that all about?
The 3-day rule is a market phenomenon where a significant price move, often triggered by a news event, tends to continue for about 3 days before things settle down.
Right.
Imagine tossing a pebble into a pond.
Yeah.
The initial splash creates ripples that gradually fade away. That's essentially the 3-day rule in action.
So we're aiming to ride those ripples of momentum, capturing those short-term price swings. What are some key attributes we should look for in a potential gap trade?
For long gap trades, where you're betting on the price going up, Pezim recommends looking for stocks that have experienced a significant gap up, ideally driven by some unexpected positive news. You want to see strong price action during the day, leading up to the gap, and a strong close in the last 30 minutes of trading, which indicates continued buying pressure. And of course, a bullish sector and overall market can further strengthen the trade setup.
So it's like checking all the boxes, making sure everything is aligned for a potential upward move. What about the float? Does that play a role in gap trading?
Absolutely. Pezim suggests looking for stocks with a relatively low float, meaning fewer shares are available for trading. This can amplify price movements, potentially leading to larger gains.
So we're looking for those stocks that are primed for a potential breakout, but even with all these criteria in place, risk management is still paramount, right?
Absolutely. Pezim stresses the importance of keeping your position size small for gap trades. Don't go all in.
Right.
Always have a clear exit plan in mind. Know your target price and your stop-loss level, and be prepared to cut your losses if the trade doesn't go your way.
Risk management, the essential ingredient in every trading recipe. So we've explored the steady consistency of regular scanning and the fast-paced excitement of gap trades. But now, get ready for the grand finale, the holy grail of swing trading, hot sector manias.
These were the trades that can generate truly life-changing returns. But they require a different mindset, a different approach than our previous strategies.
So what sets hot sector manias apart from other swing trading approaches?
Well, unlike regular scanning and gap trades, which rely heavily on technical analysis, hot sector manias are driven by narratives, by trends and stories that capture the market's attention.
Okay.
Think of it like a cultural phenomenon, something that suddenly becomes the hottest ticket in town.
Like the dot-com bubble of the late 90s when everyone was scrambling to invest in internet companies driving prices sky high.
Exactly. Or how about the surge in medical marijuana stocks after legalization?
Right.
Or the meteoric rise of Bitcoin. These are all examples of hot sector manias, where a particular sector becomes the center of attention, attracting a wave of investment and speculation.
So it's about identifying those emerging trends, those stories that are capturing the imagination of investors. But how do we spot these hot sectors before they become full-blown manias? Where do we even begin our search?
Well, Pezim recommends staying informed by scanning business articles and financial news.
Okay.
Keep an eye on social media. Platforms like StockTwits and Facebook groups dedicated to investing can be great sources of early intel.
Okay.
And remember those technical scans we discussed?
Yeah.
Often hot sector manias will start to show up there too,
Okay.
as increased trading activity drives those technical indicators.
So we're looking for those early whispers, those subtle signs that a sector is heating up.
Yes.
It's like being a trend forecaster, trying to anticipate the next big thing. And once we've identified a potential hot sector, what's the key to success?
Pezim emphasizes 3 key elements: patience, early entry, and timely exit. Patience is essential because these manias don't happen overnight. You need to wait for the right story to emerge, for the trend to gain momentum.
Right.
Early entry is crucial because you want to catch the wave before it crests, before the price becomes inflated.
Right.
And timely exit is perhaps the most challenging aspect. You need to know when to take profits before the bubble bursts and the mania subsides.
So it's about riding that wave of excitement, but also knowing when to jump off before it crashes. It's a delicate balance.
Exactly. And it's important to remember that hot sector manias are inherently risky. Bubbles can burst quickly, and if you're not careful, you can get caught holding the bag.
So we're talking about potentially big rewards, but also big risks.
Yeah,
It's like playing poker, knowing when to hold them and knowing when to fold them. And I think that's a key takeaway from all three of these swing trading strategies. Risk management is paramount.
absolutely. No matter which strategy you're using, you need to have a plan for managing your risk. Stop loss orders, position sizing, diversification. These are all tools in your risk management arsenal.
Absolutely. And I'm guessing those ideal entry and exit points will vary depending on the strategy we're using.
Exactly. Each strategy has its own nuances. Let's start with regular scanning, where the focus is on identifying stocks that are already showing signs of strength, those poised for a continued upward move.
Okay, so we've done our homework. We've got our short list of potential trades. What are we looking for on the charts to kind of give us that green light, that buy signal?
Well, those technical patterns we discussed earlier, like double bottoms and dragonfly dojis, can be excellent entry signals. Remember, those patterns suggest a potential shift in momentum, a change in the balance between buyers and sellers.
So we're looking for those visual cues that the market is giving us, those hints that a stock is about to turn the corner. And what about volume? Does that play a role in our decision-making?
Absolutely. Volume is a crucial confirmation tool. If you're seeing a stock price rising on increasing volume, it's a sign that buyers are in control and the trend is likely to continue. Conversely, if the price is rising but volume is shrinking, it could be a warning sign that the momentum is fading.
It's like checking the engine of a car, making sure it's got enough horsepower to keep moving forward.
That's a great analogy. And once we've identified a potential buy signal, we need to determine our entry point. This is where those support and resistance levels come in handy.
Okay, remind us what those are all about.
Think of support as a floor and resistance as a ceiling. Support is a price level where buying interest tends to be strong enough to prevent the price from falling further.
Okay.
Resistance is a price level where selling pressure tends to overcome buying pressure, preventing the price from rising further.
So we're looking for those points on the chart where the price has bounced off in the past or where it's stalled out. It's like finding the natural boundaries of a trading range.
Exactly. And when it comes to entry points, you ideally want to buy near support and sell near resistance.
Okay.
So for example, if you've identified a stock with a clear uptrend and it's approaching a support level, that could be a good entry point.
Okay.
Similarly, if you're looking to sell, you might wait for the price to approach a resistance level.
It's like waiting for the perfect moment to catch a wave,
Yeah.
timing your entry to maximize your ride.
Precisely. Now, let's shift gears and talk about short-term gap trades. Remember, these trades are all about capturing that initial surge of momentum. So your entry point will often be right at the market open after the gap has occurred. You're essentially hopping on board and hoping to ride that wave as far as it goes.
So it's a much faster pace, a more reactive approach. We're not waiting for pullbacks or confirmations. We're diving right into the action. And how do we manage our risk with these fast-moving trades?
Stop-loss orders are your best friend here. You need to have a predetermined exit point in case the trade goes against you. Remember, gap trades can be volatile, so it's crucial to protect your capital.
A stop-loss order is like setting a safety net, knowing you won't fall too far if things go wrong.
Exactly. And it's worth noting that Pazim suggests using stop limit orders for gap trades, which combine a stop-loss order with a limit order. This helps ensure that your order is filled at a price you're comfortable with, even if the stock is moving rapidly.
So we're setting a clear boundary, a line in the sand that triggers our exit if the price moves against us. What about position sizing? How much of our capital should we be allocating to each trade, especially those riskier gap trades?
That's a great question, and it really depends on your individual risk tolerance and your overall trading strategy. But as a general rule, Pazim recommends keeping your position size relatively small for gap trades. Remember, it's better to win small and consistently than to lose big and infrequently.
Slow and steady wins the race, right? Okay, let's move on to those hot sector manias, the exciting but potentially treacherous world of trend-driven trading. How do we approach these trades differently?
Well, with hot sector manias, it's less about technical analysis and more about identifying the story, the narrative that's driving the trend. This requires a different mindset, a different set of skills. You need to be a bit of a trend forecaster, a market psychologist, understanding what's capturing the imagination of investors.
So we're reading the headlines, following social media, trying to understand the sentiment, the buzz surrounding a particular sector. It's like being a cultural anthropologist, studying the behavior of the market.
And once you've identified a potential hot sector, the key is to get in early before the mania reaches its peak. This often means going against the grain, buying when others are skeptical.
It's like being an early adopter, spotting the next big thing before it becomes mainstream. But how do we know when it's time to exit, to cash in our chips before the bubble bursts?
That's the million-dollar question, and there's no easy answer. You need to constantly monitor the sentiment, the news flow, the technical indicators. If you're starting to see signs that the mania is peaking, parabolic price increases, excessive hype, a flood of new entrants into the market, it might be time to start thinking about taking profits.
So we're riding the wave, but we're also keeping an eye on the shore, knowing that we need to jump off before it crashes. It's a delicate balance.
Exactly, and it's important to remember that hot sector manias are inherently risky. Bubbles can burst quickly, and if you're not careful, you can get caught holding the bag.
So we're talking about potentially big rewards, but also big risks. It's like playing poker, knowing when to hold 'em and knowing when to fold 'em. And I think that's a key takeaway from all three of these swing trading strategies. Risk management is paramount.
Absolutely. No matter which strategy you're using, you need to have a plan for managing your risk. Stop loss orders, position sizing, diversification. These are all tools in your risk management arsenal.
Now, we've covered a lot of ground here, from identifying those buy and sell signals to managing our risk effectively. But there's one more piece of the puzzle that's absolutely crucial: mindset.
Mindset is everything in trading. It can make the difference between success and failure, and Pazim emphasizes this throughout the chapter.
So what kind of mindset do we need to cultivate to become successful swing traders? What separates the winners from the losers?
Well, for starters, you need to be disciplined. Swing trading requires patience. Sticking to your plan, not getting swayed by emotions or market noise.
Discipline. That's easier said than done, especially when the market is moving fast and your emotions are running high. What else?
You need to be adaptable. The market is constantly changing, so you need to be able to adjust your strategies and your thinking as needed.
Adaptability. Like a chameleon, changing colors to blend in with the environment,
Yeah.
but always staying focused on the goal, right?
Exactly. And that brings us to another key mindset trait: resilience. Trading is a game of wins and losses. You're going to have losing trades, everyone does, but it's how you handle those losses that defines you as a trader.
Resilience. Bouncing back from setbacks.
Yeah.
Learning from mistakes and coming back stronger. It's like a boxer taking a punch but getting back up and fighting even harder.
And finally, you need to have a growth mindset. Trading is a continuous learning process. There's always more to learn, new strategies to explore, new insights to gain.
Growth mindset. Embracing the journey, the constant evolution of knowledge and skills. It's like a student, always eager to learn, to expand their understanding of the world.
So discipline, adaptability, resilience, growth mindset. These are the mental pillars of successful swing trading.
And if we can cultivate these qualities, we'll be well on our way to mastering those three powerful swing trading strategies we've explored today.
Yeah.
Regular scanning, short-term gap trades, and hot sector manias.
And as you gain experience and confidence, you can start exploring more advanced techniques. Remember, swing trading is a journey, not a destination. There's always something new to learn, the new challenge to embrace.
So let's dive into some of those advanced techniques, those tools and strategies that can take our swing trading to the next level.
Yeah. One area where we can level up is with technical indicators. You know, we've touched on a few basics like moving averages, RSI, and MACD, but there's a whole universe of indicators out there.
It can definitely feel overwhelming.
Yeah.
Like walking into a massive library without a clue where to start.
Exactly. The key is to be selective, choosing indicators that align with your trading style and the specific strategy you're using.
So it's about finding those indicators that speak to you, those that resonate with your approach.
Yeah, think of it as building a toolbox.
Okay.
You know, you don't need every tool ever invented. You just need the ones that are essential for the job at hand.
Okay, so what are some essential tools, those must-have indicators for swing traders?
Well, moving averages are definitely a cornerstone. They help you smooth out price fluctuations and identify trends. The 20-day, 50-day, and 200-day moving averages are commonly used.
Right.
But you can experiment with different time frames to see what works best for you.
So if a stock price is consistently trading above its 200-day moving average, it's generally a sign of an uptrend.
Exactly. And when the price crosses below that 200-day moving average, it could signal a potential shift to a downtrend.
It's like a line in the sand, helping us distinguish between strength and weakness.
Yeah.
And what about those other indicators we mentioned, like RSI and MACD? What, unique insights do they provide?
Well, the RSI, or Relative Strength Index, measures the magnitude of recent price changes to evaluate overbought or oversold conditions.
Okay.
Think of it like a thermometer, but instead of measuring temperature, it's measuring momentum.
So if the RSI is, high above 70, it suggests that the stock might be getting overheated,
Yeah,
potentially due for a pullback.
exactly. And conversely, if the RSI is low, below 30, it could indicate the stock is oversold and might be poised for a rebound.
Okay. It's like a gauge that helps us assess whether the market is getting too optimistic or too pessimistic.
Right.
What about the MACD? How does that indicator fit into the picture?
Well, the moving average convergence divergence is a momentum indicator that shows the relationship between two moving averages of prices.
Okay.
It can be a powerful tool for spotting potential trend changes and identifying buy and sell signals.
Can you give us an example of how we might use the MACD in a swing trading strategy?
Sure, let's say you're watching a stock that's been trending upwards.
Okay.
If the MACD crosses above its signal line, it could be a sign that the upward momentum is strengthening. Potentially a good time to enter a long trade.
So we're looking for those confirmations, those signals that kind of align with the overall trend.
Precise. And remember, these are just a few examples.
Right.
There are many other indicators out there, each with its own strengths and weaknesses.
It's like having a whole arsenal of weapons, but the key is knowing when and how to use them effectively.
Yeah.
Now let's shift gears a bit and talk about chart patterns. We've touched on a few already, but there's a whole language of chart patterns that can provide valuable insights.
Yeah, chart patterns are essentially visual representations of repeating price movements.
Okay.
Think of them like footprints in the sand telling us where the market has been and where it might be headed.
So we're looking for those recurring shapes, those patterns that have played out in the past and might repeat themselves in the future?
Exactly. And there are two main categories of chart patterns: continuation patterns and reversal patterns.
Okay, let's break those down. What are continuation patterns?
Well, continuation patterns indicate that the current trend is likely to continue. Think of them as pauses or moments of consolidation within an existing trend.
Okay.
Examples include flags, pennants, and triangles.
So if we see a flag pattern forming during an uptrend, it suggests that the uptrend is likely to resume after a brief consolidation period.
Exactly. It's like the market is catching its breath before continuing on its upward journey.
Okay, what about reversal patterns? What clues do those provide?
Reversal patterns, as the name suggests, suggest that the current trend is about to change direction. We've already discussed a few of these, like double bottoms and head and shoulders patterns.
Right. Those are classic patterns that many traders use to identify potential turning points in the market. Are there any other reversal patterns that swing traders should be aware of?
The rising wedge and falling wedge patterns are also commonly used to anticipate trend reversals. Rising wedge, which forms during an uptrend, typically indicates a potential reversal to the downside.
Okay.
A falling wedge, which forms during a downtrend, often signals a potential reversal to the upside.
So these patterns are like road signs,
Yeah.
warning us of potential changes in direction. And the key, just like with indicators, is to learn to recognize them and to understand their implications.
Exactly. It's not about memorizing a bunch of shapes.
Right.
It's about understanding the psychology behind those shapes, the forces of supply and demand that are driving those price movements.
It's like being a detective, piecing together the clues to anticipate the market's next move. Now let's talk about a concept that can really amplify our trading results: leverage.
Right. Leverage is essentially borrowing money to increase the size of your position, which can magnify both your potential profits and your potential losses.
It's like a double-edged sword.
Yeah.
They can either boost your returns or, cut deep into your capital. So when does it make sense to use leverage, and how do we manage the risks?
Well, leverage can be a powerful tool for experienced traders who have a solid understanding of risk management
Right.
and who are comfortable with higher levels of volatility. But for beginners, it's generally best to avoid leverage altogether.
Start slow.
Yeah.
Build your confidence, your skills, and then consider adding leverage to your trading arsenal.
Yeah.
And speaking of risk management, let's circle back to that all-important topic. We've touched on stop-loss orders and position sizing. But what are some other techniques we can use to protect our capital?
Well, diversification is key. Don't put all your eggs in one basket. Spread your risk across different assets, sectors, and trading strategies.
Okay.
This can help cushion the blow if one of your trades goes against you.
So even if one sector or one stock takes a hit, our entire portfolio isn't wiped out.
Exactly. Diversification helps you weather those market storms. And just like with a well-diversified portfolio, it's important to regularly monitor your trades and make adjustments as needed.
So we're not just setting it and forgetting it. We're actively managing our positions, making sure they're still aligned with our overall strategy.
Precisely. Don't be afraid to take profits when a trade is going well, and don't hesitate to cut your losses when a trade is moving against you.
So it's about being proactive, taking control of our trades rather than letting our emotions dictate our decisions.
Yeah,
And finally, remember that trading is a marathon, not a sprint.
right.
Focus on the long game. Don't get caught up in the hype or the short-term fluctuations of the market. Stick to your plan, manage your risk, and keep learning and evolving as a trader.
Yeah, I think that's a great takeaway for all of us. Swing trading is a journey of continuous learning and adaptation. And with the right tools, the right mindset, and a commitment to ongoing education, we can all become more confident and successful swing traders.
Absolutely. And remember, the market is always evolving, so we need to evolve along with it. To all those swing traders out there, keep exploring, keep experimenting, and never stop learning. Thanks for joining us on this deep dive into swing trading.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries. You can also get any of Sam's books and other exclusive content. It's all completely free at samfury.com.